Let me say something that might surprise you. For most people with a solid 401k or IRA, retiring at 65 is one of the most expensive financial decisions you can make. Not because of what you spend, because of what you owe in taxes. Look, I'm not saying you have to work forever. Far from it. What I'm saying is that the timing of when you officially stop working has massive tax consequences that most people, and honestly even some advisors, never take into account. I'm PJ Gibbs with Trella Wealth, and in this video I'm going to walk you through the hidden tax landmines buried inside the traditional retire at 65 plan. From the Roth Conversion Window you're throwing away, to the Medicare surcharges nobody warned you about, to the RMD Time Bomb quietly ticking inside your 401k. And at the end, I'll give you a simple decision framework so you can figure out the retirement age that actually makes financial sense for you. Before we get into taxes, we need to talk about something more fundamental: your health. Here's the thing most retirement planning ignores. You're not just planning a financial event. You're planning for the quality of life you'll have over the next 2 to 3 decades. According to the World Health Organization, healthy life expectancy at age 60 for people in the high-income countries still stretches well into the late 70s and beyond. That means if you're in reasonably good shape at 60, you could realistically have 15 to 20 years of active, healthy retirement ahead of you. Dr. Peter Attia, who wrote that book Outlive, makes a compelling argument that your goal shouldn't just be a long life. It should be a long health span. The ability to do what you love physically and mentally for as many years as possible. That is the real retirement prize. Why does this matter for our conversation today? Because if you have that kind of runway ahead of you, the financial decisions you make at 60, 62, or 65 don't just affect a few years. They affect decades of income, taxes, and wealth. Getting this wrong is costly. Getting it right is life-changing. And if you maximize your lifespan, the taxes you'll pay later are all that more important. Here's where the tax math really starts to sting. If you retire at 65 and immediately start drawing Social Security and living off your 401k, you've essentially skipped over one of the most powerful tax planning opportunities in all of personal finance: the gap years. So what is it? Between roughly age 60 and 73, before your retired minimum distributions kick in, there's often a prime window where your taxable income drops significantly. No W-2 wages, no RMDs yet, maybe reduced or no Social Security. Your tax bracket will likely be the lowest it's been in decades. That is the window to convert traditional 401k and IRA money into a Roth IRA. Prepaying taxes now at a lower rate so you never pay taxes on that money again. For married couples filing jointly in 2026, the 22% federal bracket extends up to roughly $250,000 in modified adjusted gross income. That means a couple could potentially convert a meaningful amount each year, staying in the 22% bracket, instead of being forced into the 32% bracket or higher once RMDs begin. But here's the catch. If you retire at 65 and immediately claim Social Security and pull from your 401k without a conversion strategy, you're compressing all of your income sources into the same years. You're closing this low income window early. The conversion opportunity shrinks or disappears entirely, and the tax bill that comes later, much, much larger. If you want to explore this further, drop a comment below. I'm happy to do a deeper dive video on Roth conversion strategies specifically. But what about healthcare? When I ask people what age they want to retire, most say age 65, since that's when Medicare kicks in. But that could be costing you. Most people assume Medicare Part B has a fixed premium. And yes, the base premium is set each year. But if your income exceeds certain thresholds, you pay significantly more, sometimes dramatically more. This is called IRMA, Income Related Monthly Adjustment Amount. For 2026, the Tier 1 IRMA threshold for married couples filing jointly is $218,000 in modified adjusted gross income. Cross that line by a single dollar, and you face roughly $2,300 in additional Medicare surcharges per year per couple for your Part B and Part B combined. Here's the part that catches people off guard. Medicare uses a 2-year look back, so your 2026 income determines your 2028 Medicare premiums. If you're doing Roth conversions, taking large 401k distributions, or selling appreciated assets, even what feels like an early retirement honeymoon year, you could be setting yourself up for a Medicare surcharge 2 years down the road. This is exactly why a coordinated strategy between your retirement income plan and your tax plan isn't a luxury. It's absolutely critical. Now, Here's another retirement date most people misunderstand. Retiring early, say at 60 or 62, doesn't have to mean claiming Social Security early. In fact, when you do it right, early retirement can set you up to delay Social Security all the way to age 70, which is one of the most powerful financial moves available to most Americans. Every year you delay Social Security past your full retirement age, your benefit grows by about 8%. That's a guaranteed inflation-adjusted 8% increase per year. No market risk attached. By the time you hit 70, your monthly benefit could be 24 to 32% higher than if you claimed at 67. And as much as 77% higher than claiming at 62. So here's how this ties into your retirement age decision. If you stop working at 62 or 63 and live off a combination of savings, modest 401k withdrawals, and strategic Roth conversions, you can let Social Security grow untouched until age 70. That's the bridge strategy, using your assets to fund the gap years while you let your Social Security benefit keep compounding. Compare this with the classic 65 scenario. Many people retire, claim Medicare, start Social Security at 65 or 66, and begin withdrawing from their 401k all at once. Every income source turns on at the same time. The tax impact of all those streams colliding can push you into a higher bracket, trigger taxation on up to 85% of your Social Security benefit, as we just covered, hit you with IRMA surcharges. It's a tax traffic jam. But why are Roth conversions so powerful? Required minimum distributions, RMDs, begin at age 73 under current law. At that point, the IRS requires you to withdraw a minimum amount from your traditional retirement accounts every single year, whether you need the money or not. And those withdrawals are fully taxable as ordinary income, just like your paycheck. Here's where it gets dangerous. If you've been a diligent saver, contributing to your 401k for 30 or 40 years, maybe getting employer matches and letting it grow untouched, you could be sitting on $1 million, $2 million, or more in tax-deferred accounts by the time you hit 73. The RMDs on a $2 million traditional IRA could force $80,000 or more per year into taxable income onto your return, even if you don't need the cash. Layer that on top of Social Security, 85% of which becomes taxable at those income levels, and you can see how a retiree who did everything right their whole life suddenly faces a six-figure taxable income in their 70s, with few options left to reduce it. The antidote? Start shrinking that tax-deferred balance before 73, which brings us back to the Roth conversion window. But that window only exists if your income is low enough during those years to make conversions efficient. If you're already withdrawing from your 401k at 65 with Social Security on top, the window is practically closed before you even knew it was open. So how do you actually figure out the right retirement age for you? Here's a straightforward framework to get started. But remember, this isn't intended to be personal advice. You need to fully understand your own unique situation, goals, and risk tolerance, and seek professional guidance if necessary. Step 1, assess your health span. Are you healthy enough to work in a reduced capacity, consulting, part-time, a passion project into your early 60s? Even modest earned income during a gap year can dramatically affect your tax picture and preserve your savings. Step 2, map your income sources. List out when Social Security, pensions, RMDs, and investment income will each turn on. Look at what happens if you stagger them. The goal is to avoid turning everything on at once. Step 3, model the Roth conversion opportunity. Work with a financial planner to estimate how much you could convert annually between your retirement date and age 73 while staying within your target tax bracket and below the IRMA threshold. This single step can save tens of thousands, sometimes hundreds of thousands in lifetime taxes. Step 4, plan the gap. If you stop working at 62 and delay Social Security to 70, you need 8 years of bridge income. Where does it come from? Taxable accounts, modest 401k withdrawals, or even a part-time role can all serve that purpose. Step 5, run the numbers. This isn't a one-size-fits-all calculation. Your tax situation, account balances, health, and family circumstances all matter. But the people who do this planning early, not at 64 when they're ready to walk out the door, but at 55, 58, consistently end up with dramatically better outcomes. I often see people who have spent 30 years building wealth, then make a retirement timing decision in 30 days, without considering the tax implications. The people who consistently come out ahead are the ones who do this planning at 55 or 60, not at 64 when they're ready to walk out. The math is clear. Your retirement date isn't just a lifestyle choice. It's a tax decision. And the more you understand that before you make the decision, the better positioned you'll be for everything that comes after.